Junaid, I'm a senior analyst. I work in finance in the UK, and today I'm reacting to a video by a YouTube channel called Casual Economics, the 2008 financial crisis explained in 12 minutes. Without any further ado, let's get straight into it.
The 2008 financial crisis was the worst economic disaster in living memory. Its speed and impact unmatched since the Great Depression. In the early 2000s, people were buying homes at a record pace. You didn't even need a job to get a mortgage, just a pulse. Then...
Yeah, those loans were called ninja loans. No income, no job, no assets, which were essentially a very, very low quality subprime loans.
Almost overnight, the music stopped. Nearly $19 trillion in household wealth evaporated. Unemployment hit 10% and half the stock market's value vanished. But what exactly went wrong? And how could such a disaster happen in modern times? Let's rewind to how a booming housing market nearly destroyed the global economy. The year is 2000. The dot-com bubble has just burst and the US economy is slowing. To revive growth, the Federal Reserve cut interest rates 11 times to 1.75%, the lowest in 40 years. By the early 2000s, the US government was determined to expand home ownership, even pushing legislation requiring mortgage giants Fannie Mae and Freddie Mac bought more loans for lower-income buyers. Fueled by low interest rates and pro-home ownership policies, the housing market boomed. Home ownership hit a record 69% in 2004, and lending standards kept loosening to keep mortgages flowing. Lenders started writing subprime mortgages for borrowers with bad or no credit. Some were the infamous ninja loans. No income, no job, no assets. I lost my job. I'm looking for a small loan to pay my rent for the month. Perfect. You're approved for $600,000 and a second home.
Essentially what happens when you go in for a loan, for a mortgage or a home ownership loan, is the lender, the bank, will take a look at your job, they'll take a look at your assets that you own and the income that you earn. They'll take the income that you earn. In the UK, they'll multiply your income by 4.5, and that's the maximum amount that they'll be able to lend you. But in the case of the financial crisis, lenders were giving out loans to people who had no job, who had no income, who had no assets. And so there's a real problem in that eventually a lot of those loans are going to default, which means the people won't be able to make the monthly payments. They're going to default on those loans. And essentially what happened, I'm sure the video is going to go into this, but essentially what happened is so many people started to default on their loans, and that caused the entire housing market to crash.
Hold on, how was any of this legal? After the Great Depression, strict regulations kept banks in check. But over time, a parallel shadow banking system emerged outside those rules. Investment banks and other unregulated players took on bank-like roles without oversight or safety nets. They took huge risks with complex bets and high leverage, and no one was watching.
The issue is just that. Regulation. Deregulation. In fact, I can make a video on this because I find it quite interesting, but I think it was Ronald Reagan who started the whole push towards deregulation. Essentially what deregulation is that financial institutions had less regulations they had to work with, the less red tape and guardrails that they had to work with, and so over time that slowly spilled into illegal activity.
In April 2004, the SEC loosened the net capital rule, which had been limiting these investment banks to a 12-to-1 leverage ratio of debt to equities. With these new changes, any investment bank with over $5 billion in assets could now leverage itself an unlimited number of times. At the time, the belief was that these banks could internally manage risk better than any rulebook could. A fatal mistake. In fact, banks didn't care about risk because they weren't holding on to these loans. They bundled them into mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. Meanwhile, the credit rating agencies relied on flawed risk models and were paid by the investment banks that had created the CDOs.
It's a huge conflict of interest. I don't know about flawed risk models. They were rating the products from the institutions who paid them fees to rate their products. So to continue collecting fees, it was in their best interest to rate the bonds higher than they perhaps should have been. I'll break it down as simply as I can. So what an investment bank would do, for example, they would take one subprime loan, gather hundreds and hundreds of thousands and millions of those loans, and bundle those loans together as mortgage-backed securities, Now, the housing market, no one ever expected the housing market to crash, so those securities were seen as good, stable investments. And ultimately, in the 2008 financial crisis, the people who took the greatest hit were the customers who had bought those mortgage-backed securities from these investment banks, not knowing that the products underneath were absolute garbage.
This feedback loop resulted in agencies giving AAA ratings on bundles of loans that were basically junk. Wall Street was hooked on the fees. Subprime lenders kept making risky loans, banks kept packaging and reselling them, and investors kept snapping them up. Everyone was making money. The logic of the system was that if you spread out enough risk, it disappears. The reality was that if you spread out enough garbage, the smell just takes longer to notice. Soon enough, as those garbage loans piled up, the whole neighborhood started to stink.
What he means by those garbage loans piling up is as people started to default on their payments on those loans, the people who had no jobs, no income, no assets, which, by the way, isn't their fault at all. It's actually on the lender to have more stringent policy and work with those guardrails rather than just trying to accumulate and collect a fee, regardless of whether a person should or shouldn't be lent a certain sum of money.
The housing frenzy hit its peak in 2005. Subprime loans swelled to nearly 20% of new mortgages. Interest-only mortgages became common, letting borrowers live beyond their means. Meanwhile, global investors couldn't get enough of anything tied to US real estate.
Interest-only mortgages, that's another part of the puzzle. Now, imagine you borrow money to buy a house. Let's say $200,000 you borrow from a bank. With a normal mortgage, you're paying back the bank two things. You're paying back every month, you're paying back a bit of what you borrowed from the bank, which a bit of that 200,000, which is called the principal. So you're paying back a bit of that principal. And then on top of that, you're paying them back interest, which is essentially the fee that the bank charges you for lending you the money. Now, with an interest-only mortgage, you're only paying the bank the interest part, not the principal. So for example, let's say the bank's interest is, let's say the interest rate is 5%. Every month you'd pay back the bank 5%, none of the original $200,000 that you borrowed, none of that gets paid off. So it's like renting your house from the bank and paying them just enough to keep them happy. Then let's say your mortgage term was 25 years, then at the end of that 25 years, the bank says, okay, now give us our $200,000. Now in that case, what most people try and do is they'll sell the house and pay the bank the $200,000 back, but that's only assuming the house's value has gone up, because if you don't have that $200,000 invested or saved somewhere else, then you're in trouble. Then you're in debt, severe debt. But what people try and do is sell off that house, essentially banking on the fact that it'll have increased in value. Whereas in the case where the housing market crashes or prices stay the same, then you still owe the bank $200,000 and you won't be able to recoup that from selling the house.
Long considered one of the world's safest assets. On the surface, it seemed like the money fountain would never stop flowing. But underneath, small cracks were starting to form, and soon everything would come crashing down. By 2006, the US yield curve inverted, a classic recession signal, and a growing minority on Wall Street warned that the housing boom was unsustainable. In 2007, home prices peaked and then began to fall. Suddenly, millions of borrowers couldn't repay their loans, and defaults skyrocketed. Those mortgage-backed securities and CDOs everyone was trading, well, they turned out not to be safe as houses after all. Banks, insurers, and pension funds holding billions of dollars of these assets began bleeding cash. In early 2007, over 24 subprime lenders, including New Century, an industry juggernaut, went bust amid the surge in defaults and foreclosures. In mid-2007, two Bear Stearns hedge funds imploded under the weight of bad mortgage debts, sending shockwaves through Wall Street. Subprime loans made up only 13% of all mortgages, but they now accounted for about half of all foreclosures. As panic spread, credit markets went haywire. Bear Stearns froze withdrawals, and banks grew too afraid to lend to each other. The Federal Reserve stepped in with emergency moves, cutting interest rates and injecting cash into the system to keep money flowing. By early 2008, the housing bust hit full force. Roughly a quarter of subprime mortgages had defaulted, and millions of homeowners went underwater, owing more on their mortgages than their homes were worth. Then in March 2008, Bear Stearns, one of Wall Street's oldest investment banks, neared collapse. In a last-ditch...
Jim Cramer used to have a show on some network. I remember seeing a clip of him saying, "Don't take your money out of Bear," the way Jim Cramer does. And I think maybe perhaps 3 days later, I'm not entirely sure of the timeline, but perhaps 3 days later, Bear Stearns collapsed.
Rescue, the Fed helped broker a fire sale deal. JP Morgan Chase would buy Bear Stearns for just $2 a share, later raised to $10, with a $30 billion federal guarantee to seal the deal.
This is where the bailout begins, where the government stepped in. Essentially, the banks were so big that if they were allowed to fail in this manner, it would have caused economic chaos. And so the government had to step in and bail them out, because otherwise it would have been economic Armageddon of sorts.
As the crisis deepened, the US government seized Fannie Mae and Freddie Mac on September 6, 2008. These two mortgage giants, responsible for about half of all US home loans, were on the verge of failure, so the government stepped in to prevent an even bigger meltdown. Yet the worst was still to come. On September 15, 2008, Lehman Brothers, overexposed to toxic mortgage assets, went bankrupt after the government refused to save it, the largest bankruptcy in US history. The next day, the giant insurer AIG, crippled by mortgage losses, was rescued by the Fed with an $85 billion loan. By then, credit markets were frozen and the entire financial system was on the brink of collapse. With the financial world in freefall, Congress hurriedly passed a $700 billion bank bailout known as the Troubled Asset Relief Program, TARP, in early October 2008. It was a desperate bid to stabilize the banks and a stark acknowledgement of how close the economy was to total meltdown. The waves of damage quickly moved through the rest of the economy. The stock market collapsed, with the Dow Jones down nearly 40% from its peak by October. Credit had dried up. It was full-blown financial panic. Lehman just filed for bankruptcy. It's real. London wants to know if we're still good for that $2 billion in CDS exposure. What even is our exposure? We're holding CDOs squared, something called a synthetic mezzanine. Those make up 90% of our firm. And it's all gone. What? Trenches defolded, swaps triggered, everything marked to zero, all of it's gone. Poof. While the crisis started on Wall Street, it didn't end there. About 4 million Americans lost their homes, and another 4.5 million fell into foreclosure or mortgage arrears. Approximately 8.7 million Americans lost their jobs, and unemployment hit 10%. The collapse didn't stop at the US border. European banks that had gorged on US mortgage securities were on the brink of failure. Iceland's entire banking system collapsed. Global stock markets plunged. Many were down 40 to 60% from their highs. And world trade shrank by nearly 10% in 2009. What did we learn? First, deregulation with no guardrails can be dangerous. The financial sector had too many loopholes and not enough oversight. Banks and investors gambled on exotic financial products like CDOs and credit default swaps without fully understanding the risks.
Another important piece of the puzzle is understanding CDOs. Now remember, CDOs are just bundles of, let's say in this case, bad subprime loans. What investors were doing were buying bits of each CDO and combining them with bits of other CDOs. Essentially, CDOs squared. Some of those loans were good, some of them were bad. Now, let's take that up another notch. Synthetic CDOs. Synthetic CDOs they're not even actual loans. They're just investors saying, I'm guessing this CDO will fail or succeed. Essentially, people gambling on other people's, in this case, bad debt. Now that snowball effect turns bad mortgages into hundreds and hundreds and billions of losses.
Second, the watchdogs failed. Credit rating agencies slapped AAA ratings on toxic mortgage bonds because banks paid them to. And ultimately, they underestimated the risk of widespread mortgage defaults. Third, the Federal Reserve dropped the ball. Fed Chair Alan Greenspan's policies kept interest rates too low for too long and trusted banks to regulate themselves. These economic conditions helped inflate the housing bubble, and no one stepped in to rein it in. Finally, complex doesn't mean safe. Wall Street's quants relied on fancy risk models, but they wildly underestimated how correlated everything was. When the housing market cracked, the entire global system shook. Lehman Brothers' collapse wasn't just one company going under, it was the first domino in a chain reaction that nearly brought down the whole financial system. After the crash, the US government and the Federal Reserve intervened on an unprecedented scale. They bailed out the banks with the $700 billion TARP program that injected capital into failing financial institutions. These moves stabilized the system, but infuriated the public.
I mean, all those companies are still around to this day. At the end of all of this, the people who were actually responsible, none of them were really held to account. They still took their fees. I think one banker went to jail. I think that was the headline. One banker went to jail.
Many, it seemed like Wall Street was being rewarded for its misdeeds. Taxpayer money had saved the very firms that caused the mess. The backlash was fierce, and people worried about a moral hazard. The idea that bailing out bad actors would encourage more bad behavior in the future. At the same time, policymakers scrambled to restart the economy and reform the system. The Fed cut interest rates to near zero, and in early 2009, President Barack Obama signed the American Recovery and Reinvestment Act, a $787 billion stimulus bill to jumpstart growth and jobs. In 2010, Congress passed the Dodd-Frank Act, the most sweeping financial reform in decades, to tighten oversight, routinely stress test banks' health, and prevent another crisis. Dodd-Frank created a Consumer Financial Protection Bureau to protect consumers and imposed the Volcker Rule to stop banks from gambling with depositors' money. In short, it aimed to ensure that nothing like 2008 would ever happen again. Globally, policymakers rolled out Basel III, a set of international banking rules that forced banks to hold more capital and take on less risk. The economy slowly recovered, but the pain lingered. The Great Recession officially ended in June 2009, but it didn't feel that way for ordinary Americans. Unemployment stayed high for years, and it took until the mid-2010s for home values and household incomes to get back to pre-crisis levels.
Now you might be thinking, how is unemployment affected by banks losing money or banks failing and all this happening in the background? How does that affect jobs? So essentially what happened is that banks started hemorrhaging lots and lots of money. I'm talking in the billions getting wiped out overnight. And they essentially stopped trusting each other and stopped lending each other money. So credit basically froze. So lending essentially basically froze. Now businesses in the economy, they run on credit. They run on lending. They borrow to pay for supplies. They borrow to rent offices. They borrow to expand, whatever it may be. They borrow, they take a loan. Now, if a bank refuses a loan, then your business is going to go under. So when a bank doesn't give you that influx of cash, it doesn't give you credit, it doesn't give you a loan, the business is going to cut costs another way, which in this case is layoffs. And then those people who lost their jobs, they in turn stop spending, which in turn hurts businesses. So businesses are getting less income and they're having to lay off more people. And unemployment went up so high because cash and money stopped flowing.
Even the stock market took 6 years to regain its 2007 peak. The scars of 2008, foreclosed homes, lost jobs and shattered trust endured long after the crisis. It wasn't just a few greedy bankers or a handful of unlucky homeowners that caused the crash. It was an entire system, a house of cards built on bad loans, fragile trust, negligence, and the belief that housing prices would never fall. Many on Wall Street truly believed they had solved the problem of risk. In truth, they simply buried it. Financial innovation isn't bad, but forgetting what you're investing in is. If something sounds too complex to fail, it's probably too complex to trust.
So that was a great video. It broke it down into simple, manageable chunks. I think this kind of case study is absolutely fascinating. If you go all the way back and see each domino that was set up back all the way in the 70s and 80s that came back and fell and started a chain reaction, I think the crisis is a fascinating case study. Yeah, there you have it. That's all for this video. I hope this video was useful. If it was, be sure to leave a like and subscribe. Actually, let me know down below what other videos you'd like me to react to, and I can react to those and give you my input on those. So thanks for watching, and I will see you guys in the next one.